Stocks dropped hard today. The S&P down 1.6. Nasdaq lost 2. But the move that should grab you is gold, which got smoked 4% on the same day. Stocks and gold falling together does not usually happen. When it does, it is the bond market telling you it won the argument. The inflation print this morning came in hot, and within minutes everything that does not pay a yield got repriced. The bigger story is not the print. It is what Bank of America did to itself today. Same firm, same morning, two separate desks published notes pointing in opposite directions. One told you to buy this dip, the US economy is exceptional. The other told you their own clients are dumping tech at a rate we have not seen in over a decade. The flow desk at Bank of America tracks what their actual clients are doing with their money. Last week, that number was $14.2 billion. That is institutional single stock selling, the biggest weekly outflow since last November. And what caught their attention was the coordination. Hedge funds were selling. The big institutions were selling. Even private wealth clients who normally hold were sellers. All of them in the same week. The selling was concentrated almost entirely in one place: technology. Bank of America says tech selling, measured as a percent of the sector's market cap, was the largest since February 2014, 12 years ago. Meanwhile, the place getting the inflows was healthcare. The biggest weekly healthcare ETF inflow since October 2021. The rotation is real, and it is being led by the people who manage other people's money. Here is the part that is hard to square. While the flow desk was logging that data, Bank of America's macro team was publishing the opposite read. Their note is called The Exceptional Economy, New Industrial Cycle, Wages Picking Up, Job Openings Still Exceeding Unemployed Workers. They have a long-term S&P target of 9,600. Their advice on the recent pullback: use it. Two desks, same letterhead, two different markets. This is the regime tell. When inflation runs hot, the bond market wins. The 10-year yield touched 4.56 today. That makes anything that does not pay a coupon more expensive to own. Gold got hit hardest, down 4%. The Nasdaq fell 2. Semis got smacked 3.5. What worked? Energy, staples, utilities. The boring dividend payers. That is not a normal sell-off. That is a market repricing for a Fed that may not cut it all this year. So what comes next? Tomorrow morning at 8:30 Eastern, the wholesale inflation print PPI. If that runs hot, the flow desk is right and the rotation accelerates. If it comes in cool, the macro desk gets vindication and you get the bounce. Then next Wednesday, the Fed has to either confirm or push back on what the bond market just priced in. 8 days, 2 binaries. And the Bank of America split tells you exactly where each side thinks the puck is going. Daily synthesis of what the big banks and Wall Street quants are seeing. Follow.